things like PSLV or physical precious metals, I personally consider to be cash, albeit volatile cash. And if you consider, as an example, PSLV or silver to be cash, you have to be willing to sell it even at a small loss during periods of time where you need the cash for higher and better purposes. So for me, I regard physical precious metals or physical precious metals surrogates as good but volatile cash. Perhaps you should call them liquidity. For other people, the volatility in US dollar quotes for silver obviates many people's psychological ability to use them as cash. In terms of cash in a brokerage account, that really depends on the broker. When I ran a brokerage firm, Sprott Global Resource Investments, I had 16 choices in terms of clearing firms, which is to say 16 choices among firms that would hold my clients' accounts and assets. I chose the clearing firm that I chose, RBC, a subsidiary of the Royal Bank of Canada, because it had the only balance sheet among the 16 clearing firms that I understood. I liked their speculative derivatives position, which was 0. I thought that was a really good number. I liked the fact that they weren't time spread lenders, which is to say funding long-term liabilities with short-term borrowing. So cash in brokerage accounts really is a function of understanding your broker's balance sheet and income statement well. Similarly, some banks are better than other banks. Banks is an example like Farmers and Merchants Bank of Long Beach, where equity is 18 or 19% of total assets, which is to say old-fashioned banks, banks that have money in them, over and above the U.S. government guarantee is a good thing. I should tell your listeners that I'm conflicted in this. I am, despite the fact that I'm 69 years of age and retiring, backing Frank Trotter and the old group from Everbank in starting a brand new bank. One that will be a suitable place to store my own rather large cash deposit balances. I'm not comparing myself with Buffett or anything like that, but relative to the deposit needs that I had 20 years ago, my deposit needs are large now. And I have been involved in creating a financial institution that will, I hope, when we get our charter, be in the top decile of payers of deposit interest nationwide, while simultaneously being an extraordinarily safe bank. A bank that doesn't take time spread risk, a bank that isn't a spread lender, a bank that doesn't speculate as a counterparty in derivatives trades, rather an old-fashioned bank that lends on secure assets and treats its depositors well. Let's first start by testing your viewers' faith and talk about two things that could cause the precious metals prices to go down as opposed to up. I think you need to look at both sides of the equation. The first challenge is that if the real interest rate in the United States goes less negative, that is to say, if the Fed actually is able to increase the interest rate market in the United States, a circumstance right now where the U.S. 10-year Treasury is yielding 2 in a currency that's depreciating by 6.5% a year is a no-brainer for gold. But if the interest rate were to go up, that is to say, if the 10-year Treasury or CDs or other savings products began to offer a better relative value, that would be harmful to gold. But a second thing that could happen to precious metals in the nearer term that people need to take into account is the fact that maybe the only asset that the Russians have that they can turn into cash right now is gold. Gold is fungible. Gold could be sold by the Russians to, as an example, people in Dubai and be rebranded as Dubai Gold. Now, maybe the Russians would have to take a discount. And I'm certain that the Russians don't want to sell their gold, but I think the Russians might be putting themselves in a circumstance where what they want is somewhat less relevant than what they can have. And I think I think gold holders need to be considerate in the next 6 months about the possibility that the Russians have cash needs in terms of consumables and imports in their society that they can't fund through normal commodity sales, which would settle in US dollars. The most obvious alternative, particularly for imports from China and India, would be gold. And that might put pressure on the gold price. And I think that people who get their sense of value around gold from the price quotes day by day and would be overly concerned about a fall in the gold price from, say, 1950 to 1750, need to consider the fact that that's a possibility given Russia's cash needs in the next 6 months. If we look out further, I think both the interest rate challenge and the Russian challenge are easy to overlook. Easy because I think that on a global basis, the economy of the world, but in particular the U.S. economy, can't stomach higher real interest rates for any length of time. We've talked about this before, Donegan, but let's do the arithmetic for people who haven't heard about us talk about that. Traditionally, the U.S. 10-year Treasury, the world's benchmark security, has offered a positive real yield with, depending on which government agency you listen to, the depreciation of the value of the U.S. dollar being between 6.5% and 7.5%, and the U.S. 10-year Treasury yielding 2%. The real yield on the U.S. 10-year Treasury is a function of taking 2 and subtracting 6.5, a truly ugly number. If we were to revert to mean in terms of pricing of the U.S. 10-year Treasury, then the interest rate would have to rise to 6.5 or 7. Can you imagine the impact of the federal, state, and local budgets of a tripling or quadrupling of their interest charge? Can you imagine the impact on consumers if their credit card interest rate doubled? Can you imagine, too, if the 30-year fixed mortgage rate returned to mean? Because the 30-year fixed mortgage rate has traditionally traded at a premium to the 10-year Treasury rate. If the 10-year Treasury rent went to 7, that would suggest that the 30-year fixed mortgage would have to trade at 8. Imagine what that would do to housing affordability. The point of this soliloquy isn't all arithmetic. It's to say that the probability that the policymakers can make substantial interest rate hikes stick is, in my opinion, nil. There could be a near-term impact on gold if the nominal interest rates go higher. But I don't believe that the policymakers will be able to afford an honest economy, an honest interest rate environment for the next 5 years. And the consequence of that is that from my point of view, there is a strong probability of higher gold prices. When people ask me why this hasn't been reflected to the market, I ask them to reflect on history. Perhaps because I'm older than most of your viewers, that's easier for me because I lived through history. But I remember, although I was only in high school, in 1967, 1968, the writing was on the wall for higher inflation. We had the war in Vietnam, which of course we lost, and the war on poverty, which we lost too. And we had a circumstance in the 1960s where we were living beyond our means. And we began to inflate away the difference between our obligations and the net present value of our servicing capabilities through inflation. But the consumer didn't pay attention. The consumer had lived through the 1950s and most of the 1960s, which were very benign economic times. And the consequence of that is that the academic subject of inflation didn't attract any action until the consumer had lived through 3 or 4 years of inflation, until, despite the fact that he or she were getting pay raises, their standard of living was declining as a consequence of the deterioration of the purchasing power of the dollar. And I see the exact same thing happening now. Voters and consumers have lived through the 40 most benign economic years in the history of mankind, between 1982 and 2022. And the consequence of that is that confidence in the economy, confidence in the system is extraordinarily high. People look at the price of gas at the pump and they say, oh, well, that's Russia. They look at the price of bread. Perhaps they say, oh, that's Russia. Perhaps they don't know who to blame. But after 40 years of benign economic circumstance, they think that 6.5% deterioration in the value of their savings is an interesting academic anomaly. It's not. It's a threat to your listeners' well-being. And as that threat manifests itself over 2 or 3 years, the confidence born of 40 years of benign economic climate will be swept away, much like it was swept away in the later part of the decade of the 60s and the early part of the decade of the 70s. I would ask people, too, to consider past precious metals bull markets and the performance of these bull markets. Although from trough to peak, these markets were extraordinary, $35 to $850, pardon me, in the 1970 to 1982 bull market, $250 to $1,900 in the 2000 to 2012 bull market. In both markets, there were periods of volatility where the market declined by 25 or 30%. And certainly in the case of the 1970s bull market, there was a hiatus in the middle of the market that saw the gold quote decline by 50% without derailing the bull market. The malaise that we have seen in the gold bullion market and certainly the gold equities markets in the 16 months, probably ending 2 months ago, while it tested shareholders' patience and metals holders' patience, is certainly consistent with the occurrence of similar periods of gold weakness in prior bull markets. And your listeners need to familiarize themselves with that history in order to understand the circumstance that confronts them today and in order to chart their own response to the markets that they see themselves in.